I just don't know how to analyze deals. Is it a good deal? Should I walk away? These are the things that I hear from new commercial real estate investors and the anxiety they have that ultimately prevents them from taking action and getting in the game. So in today's video, I'm gonna be breaking down a real commercial real estate opportunity, one that actually one of my commercial mastermind members closed on. And we're gonna go over the exact deal analysis, the sheet that we use, how we input the numbers, if there's any red flags, if there's any green flags, and what he used to make the decision to move forward on closing this deal. So that way you can get more reps and see how other real estate investors are leveraging deal analysis to give them the confidence to move forward with their investing goals. Let's dive in. Hey, what's going on, wise investors? Welcome back to the channel where we help you master commercial real estate and build wealth. Today, I'm gonna be walking you through a real deal and showing you how we analyzed it step by step. Now, whether you're a seasoned investor or you're brand new to commercial real estate, this will give you a framework to make smarter, faster investment decisions. So let's go ahead and dive in. Today, we're playing a little game of invest or pass, and really just how to analyze a commercial real estate deal. So in this video, I'm gonna show you in this little presentation just some overall highlights of this deal, and then we're gonna dive into my actual deal analysis sheet and see how in real time this deal makes sense or it doesn't. So this is a Family Dollar and a Dollar Tree combo new construction opportunity. So just to give you a little overview of what this property is, and we take a lot of this information from the marketing sheet. You know what? I'm gonna go ahead and show you the information right now. So generally you're gonna see when a property is being listed by a broker and being marketed, they're gonna have what we call an OM, or an offering memorandum, or a marketing package. And this is ultimately what we use to take all of the information that the owner and the broker are sharing with us based on the deal itself. And these are gonna be a lot of the things that we're gonna go ahead and use to analyze the deal and to input into our spreadsheet. But overall, you can kind of see the location, right? How many cars per day are driving past, what other businesses in the area may be good or bad to know about, right, near your property. And ultimately, just getting the property description, talking about some of the terms and the highlights of this particular investment. It'll give you some demographics, which are always helpful to understand when you're doing a little bit more due diligence on a particular market that you may not be familiar with, right? And understanding population growth, understanding household income. These are definitely some important things. Crime. We've got a lot of other, demographic things in our checklist that we do with our due diligence. But for the sake of this one, right, understanding who the tenant is and their strength, right? Or understanding if there's a tenant that's going in there that you're not aware of, and getting a little bit more comfortable with the business and the brand. Here's some more information around the property, right? Overall, it looks like it's in good condition. This property is actually a new build that was built in 2023. Tells you a little bit more about the building size, right? What their asking cap rate is based on the net cash flow of the property and what the asking price is. So these again are what we're going to use eventually when I take you through and we plug all of the information into these different cells that I will go over tab by tab. So again, we like to take the marketing package and just kind of sort through a lot of the information. Oftentimes, I'm gonna throw that into ChatGPT, and we've got prompts and other AI videos that you can watch, and we train on inside of the mastermind group that show you how to literally take this marketing package, put it in ChatGPT using the right prompts, and going through the process. It's going to pick and pull a lot of information out here for you and summarize a lot of this information. So I just wanted to give you a quick idea of this is where we pull a lot of the info that we're ultimately going to use to input into our spreadsheet. So let's get back into the presentation and go over, some of the property highlights. So Of course, here's the address, the year built. It's a newer build, which obviously newer construction is always great for obvious benefits. Building size, we want to know the size and the square footage of not only the lot, but of course, the physical structure of the property. So that way we can understand and play a little bit more around trying to get it under replacement cost or what our price per square foot is. And looking at the lot size, great. Property type, so retail, this is a double net lease. And if you watch some of my other videos, right, you understand kind of leasing 101, what the differences are with some of these lease structures. Now, a double net lease is, of course, going to be a hybrid of the expenses being shared between the landlord and the tenant reimbursing the landlord for some of those expenses. So that is a positive. Ideally, we'd love to see a triple net, but a double net is great. And then the tenant, of course, Family Dollar Store. We like those big national brands. Now, not all big brands are created equal, but overall, this is a really strong national brand and tenant. So overall, we like to see, some of these property highlights. And then, of course, we need to understand the financial information that the broker and the seller are providing to us. So that way we can plug these inputs into our deal analyzer. So their asking price is 1.368. The cap rate on that 1.368 based on its net operating income is an 8.25 cap rate at their asking price. And again, this is just what they're asking. And it doesn't mean that's what you have to pay, right? The cash flow in year one, showing what the net operating income and the cash flow to you as the investor will be. And then it just shows what the overall rent is from a price per square foot perspective. So again, just some little highlights of the property and some of the investment takeaways. This is a corporate-backed triple net lease with 8.5 years remaining. So anything over a 5-year term, right, between 5 and 10 is good. 10 plus is great, because if you watched the Leasing 101 video, the stronger and longer the lease is with a national corporate credit grade tenant, the more stable your income is, which means the more value is going to be insulated into that asset. And investors coming in, they like strong, stable income streams, right? So a good, strong national tenant, long-term lease overall, and we call this the remaining term on the lease. So 8.5 years remaining on the term, a strong 8.25 cap rate, and a stable retail asset. Minimal landlord responsibilities. The only thing that's being passed back on as a responsibility to the landlord, if any of these things come up, is going to be if there's any roof repairs or issues that come up, or any structural repairs or issues that come up. Otherwise, all the responsibilities of maintenance are going to be passed back on to the tenant, as well as, I'm assuming, and we'll have to do more due diligence on this, that the taxes, the insurance are also being covered by the tenant and reimbursed back to the landlord. Predictable, passive cash flow with built-in renewal upside. Having some of those escalation clauses every year in the base rent is important, and obviously something that we want to dive in and do a little due diligence on. And then the location sits in a growing market. Demographics are trending in the right direction. There's some good stuff overall at a high level, just quick glance from the marketing package, that we can say, hey, this property is, relatively decent. It's worth doing a little bit of a deeper dive in. So now we're going to do some further due diligence, and ultimately we're going to start diving into inputting the information we have into the deal analysis sheet, which we'll do here in a quick second. But real quick, when we're doing just some overall high-level analysis of this deal, some of the questions that you want to ask yourself as a real estate investor is, number one, based on this asset and what is required to get the returns that I want, is the strategy aligned with my goals, my time, my skills, right? And so these are some of the things that you're going to want to think about. Does it match your investment strategy from terms of cash flow, from appreciation? Is it really active management? Is it really passive management? This is something that you're going to want to think about when looking at and analyzing properties. If you're somebody that's looking for passive deals and you're okay with slow, steady, stable growth as long as all the other, key boxes that are important to you are checked, then this would be a great asset that's aligned, versus if this was maybe an asset that's 50% vacant and needs a ton of work, and you're going to do a value add play here and strategy, but you work full time and you don't have the ability to do all of these things that are required to make the asset stable and profitable and valuable, then this asset probably wouldn't be aligned with your strategy. Number 2 is return expectations, right? So does the 8.25 cap rate beat your target return? What you're actually looking to get out of this investment based on how you structure the deal, do you need to get this asset at a higher cap rate? Are you willing to buy it at the 8.25 cap rate? Those are things that we'll play around with in the spreadsheet, and you'll see this in real time. Will this deal hit your cash on cash or IRR goals over your projected hold time? Is there a realistic exit or refinance opportunity based on the numbers that align with what you're looking to do with your capital? Number 3 is risk and market position, right? We always want to make sure that while we believe in the plan for capturing the income and the equity growth that we desire, we also want to make sure that we're protecting our downside and we are mitigating as much risk as we possibly can when we're analyzing deals. So how secure is the tenant? If there was only 1 year left on the lease with this tenant, right, that would be something that would be more concerning versus 8.5 years left on this lease. That gives obviously plenty of time for the investor to plan, to strategize, and ultimately just to kick back and collect based on the way the lease is structured. What's the backup plan, right? If they leave in 10 years and at 8.5 years, they decide that they're not going to renew their lease, what's the backup plan? Well, based on how we analyzed this deal with Greg, we said, hey, if this tenant moves out, we got a great, building in a decent location, and we could chop this up and turn it into 2 tenants. And based on how this construction is, this would be suitable and good for other tenants to come in and backfill. So we feel good about, hey, worst case scenario, they don't renew and stay. We've got a plan for how we would strategize on backfilling those spaces and getting it leased back up again. Would another tenant want this building in this location, right? This is important because just because one tenant wants it, once a property goes vacant doesn't mean that other tenants are going to want to come back into that particular property, or based on how the tenant had that property set up or built out, that they're going to want to go in and see and feel and use the asset the same way as the previous tenant, right? So those are just some of the things that you want to think about. Of course, also making sure that when you're doing analysis that you are overestimating what the timelines are for achieving your goals, that you are underestimating, the construction, or you're overestimating the construction costs. You're building in some safety nets, right? I like to overassume where people underassume, and I like to underassume where people overassume. We just want to give ourselves some buffers when we are analyzing deals, right? So that way, worst case scenario, you know what it looks like. And if you can live with that, okay, then you can still move forward with the deal, assuming that likely it's not going to happen, but if it does happen, you already planned for it and you know that you can work through the challenges that may come, even if that does happen. And if it doesn't, great, right? You're just crushing the deal and you know that you looked at it from all different angles, which is really important when you're analyzing a deal, because most people look at it through a best case scenario lens instead of planning and strategizing through a worst case scenario lens. Last is responsibilities and reserves. Are you comfortable covering the roof if needed, right? So just thinking about, okay, if this does happen, maybe I should put aside some reserves for this and model that into my deal. And does the deal still make sense with me having to plan for those potential capital expenses in my reserves? And do I feel okay with that? Have you planned for reserves or future capital improvements, right? This is something that a lot of people go, oh, that won't happen. Or, I'm going to just, put a little tiny bit of money here, assuming that I'll figure it out along the way. No, you want to prepare for the worst in day one and have that all baked in and insulated into your deal. So that way, if and when you decide to close on it, right? You know that you are prepared and ready to execute on a great business plan that you're probably going to crush it on. But if something does happen, you've got some of these buffers built in and you're protecting the deal so that way it doesn't get blown up. So invest or pass, right? The deal decision checklist. You're going to pass if you need stronger rent growth or more upside and it doesn't meet your returns. You're not comfortable with the double net structure. You're concerned about, small market tenant replacement risk and going, hey, if they vacate, I don't think I'm going to be able to fill this building back up. I can't take that risk, right? You don't have a clear path to exit or refinance the property or re-tenant the property. Now, you are going to want to invest if the 8.25 cap rate return meets or exceeds your personal benchmarks. You're seeking low management, stable income. You feel good about that long-term lease. You feel good about that tenant. You feel good about the guarantees that are baked in there. You trust the tenant and their concept, that you believe in the business plan and the model. You've planned for lease rollover or re-tenanting if that happens later down the road, and you're aligned with a long-term hold or exit strategy. So let's go ahead and dive into the numbers on this deal, because this is really going to be helpful for understanding how we take a lot of the information that you saw in this marketing sheet as well as in the presentation, and how we can put this in here. So overall, we'll start first by just putting in the property name and information. When was it built? And we'll go, that's 2023 actually, 10,000 square feet, right? And a lot of anything that's blue is stuff that we can update. Anything that's, static and normal is going to be pulled in from other tabs. So a quick analysis, we took the income, right? And no vacancy because there's only one tenant in here and we know they're going to be in there for 8.5 years. And because a lot of the expenses are being passed back on to the tenant, we don't have expenses tied here because that's all getting reimbursed. So this is the true net operating income. So just plugging this information in real fast, he wants to get it at a 9 cap. And so based on the 9 cap number and taking the net operating income, which we know the formula for taking NOI divided by the cap rate gets us a value, we're starting to see that, hey, I want to get it at a 9 cap. That would be at 1.25. He had talked with the broker and the broker said, hey, I think the seller may be open to, your price at that 1.25. So let's, see if you can put something together and get an LOI in front of the seller. So he decided, okay, based on this quick 2-minute analysis on these numbers, let's go further into this process and really do a further underwriting and deal analysis of this particular property. So we're going to go to the next tab, which is putting in the information of your tenants. Okay. So you're going to want to put in the information of your tenants. This one's really simple because we only have one tenant. So 10,000 square feet. This one tenant takes up the entire property. They are paying this $9,400, which obviously gets us to this annual rent number that we pulled out of the marketing sheet, which puts them at that $1,129, which we saw in the marketing sheet. And in the sake of this scenario, we are only toggling between full service gross and triple net. So we can make adjustments, even though it is double net, for the sake of this particular analysis, it'll still calculate properly. Now, because in their term, they have a rent increase at the end of their lease term that jumps up significantly, we're baking in no annual rent increases year over year. And they are reimbursing $25,000 in expenses in taxes, insurance, things along those lines. And we put their lease date in here. They started when this was built new in 2023. It's a 10-year lease, 2033. So this information will populate into our P&L year over year over year. So we start by putting all the tenant information in here first. Now, if this tenant was going to eventually, maybe vacate in 5 years and it was only going to, 2028, and we were going to model in another, rent bump or increase or something along those lines, right? That would start factoring in starting 2028, and depending on what that lease term is, we would have it end there. And again, these new numbers would start factoring into the P&L based on when it started in what year. So just know that for the sake of this one, it's pretty simple because he's only going to be holding the property for 8 years. I think that's what he's doing. Let's see. Yep, so 8 years, and we'll get to this tab here in a second. So really, he's not too concerned about modeling out a pro forma of what it can be because he knows what it's going to be for the entire time while he's holding it. So now that we have this information in here, we are going to roll over to the CapEx. Is there any renovations or improvements that need to be done and accounted for that we're going to want to make sure what money is required to go into improving the asset is going to be factored into this model? But because this is a 2023 build, new construction, right? There's not going to be any capital expenditures that need to get invested into the property when he purchases it because it's already in great condition. So nothing here, but if you did have something that, hey, this roof is 30 years old and I know that I'm going to have to replace this roof while I'm holding this property, you want to factor in all of your capital expenses that are going to go into this investment while you own it. Next, we're going to roll over to the acquisition costs. Acquisition costs are essentially all of the information or all of the expenses that you're going to incur by purchasing this property. So you can see here, right, if you have to, set up a new LLC, you're going to want to put your LLC fees in here. If you're doing any inspections, you want to factor those in, right? Is there any reports, or if your lender is going to cost an appraisal fee? So he factored in all of his costs here. And also, right, are there going to be any reserves that your lender wants you to escrow real estate taxes or insurance? For this example, he didn't have to. So these are his total closing costs, which again are going to get factored into the total amount of cash that we as the investor need to bring to the table. You'll see where this all kind of populates in as we move through. Next is my favorite tab, which is the scenarios tab. The scenarios tab is where we're going to run a bunch of different scenarios. Best case, worst case, will they do sell or finance? What is the current as is, analysis based on the numbers that they're giving us? So we always start by taking the information that is in here, and we're going to just we take the as is marketing info and we put it in the as is tab. So the asking price is 1,368, right? We're putting that in here and we start, you can see 1,368. He's putting in the information around, hey, I want to put $4,000 down on this property. I'm going to get a loan for $845,000. And normally CapEx would get factored in here, but because we don't have that, right? That doesn't need operating reserves. I would suggest that you always put about 6 to 9 months of operating reserves in the account, 6 to 9 months of your mortgage payment in the operating account, just as a reserve, in addition to obviously anything else that you may feel you need to have in there to be comfortable. We want to know the total amount of cash that you're going to have to infuse into this deal and part with. And that's going to factor into what your returns are on that cash, right? What your IRR is. So again, making sure that you can put as much info in here as possible. But our total acquisition cost is the 1,160. It pulls in the information from our leasing matrix tab into here, right? So if I come back over here, we can see that the annual rents is $112,875. And here I've got the annual rents, and then we've got some of the reimbursements from this because it's triple net at $25,000 as well. So the total income, effective gross income at $137,875, and then we've got the $25,000 in expenses, right? That's really getting reimbursed up here. We are accounting for it down here as well. So again, total net operating income, we want to reflect what is in here. So NOI, let me find that in here. Oh, I had it in here somewhere. Let me find it for you. So there we go. Net cash flow, 112,875 is the net cash flow, right? 112,875 at an 8.5 cap. Great. So we're just verifying that's correct. And then he is getting a loan. He plugged in his financing numbers based on the lender he talked with on this deal. He plugged in his, and again, you can get a general feel when you talk with enough lenders around what loan to value are they going to offer you, what, and in his case, they said, hey, we'll give you 25%. So he just kind of took it up to 27 loan to value, and they're going to give him, he initially modeled a 7.25, but the bank said we can give you 691. So he put 691. It's a fixed rate. It's going to be amortized over 20 years. It's not an interest-only loan. So now it's factoring in his debt service. And here's the amount of cash, net cash, that is left over once the net operating income services the debt. This is what's left over. So his cap rate going in at the price that he got it locked up, which was the 1150, he got it locked up at almost a 10 cap. Debt service coverage ratio, we know that the income covers over, generally the rule of thumb is you want it 1.25, 1.3. Every lender has different thresholds, but debt coverage ratio, if you can be at 1.3 or better, that's usually going to mean that a lender is going to see that as a safe and satisfiable metric for them to want to lend on the property. So overall, this is the deal that he is getting. If we put it at the 1,368, that's right where they were at, right? So he just started kind of reverse engineering where he wanted the price to be at in order to get the cap rate going in that he wanted. And you'll see, right? And we played around with a bunch. So other times I'll play around with seller finance and say, hey, if the seller's willing to carry back paper and do, let's call it 24 months, 2 years of interest only, right? You can start playing around with some seller finance stuff in here. But for the sake of this one, he ended up offering here and he landed at this price. So let's go over to the deal summary. You can see here, it's pulling from scenario 1. So whatever scenario you're working off of, just make sure that the deal summary is pulling off of the right one, right? So he's pulling off of number 1. And he put in here his 1% earnest money deposit. Now, if you're somebody that is, acquiring a deal on behalf of a group and you want to charge an acquisition fee, you would put that in here. He is not. He's just buying this for himself. So this just kind of shows the income and expense highlight of year 1 right out of the gate, which is pulling from this P&L tab out of here, just to give a quick summary of what year 1 is going to look like. And then you can see what some of the cash on cash indicators are. And if he was, splitting this up with partners or doing something like that, then he would, factor this in around if you're doing a syndication, you're doing a 90-10 split, whatever it may be. But again, this is just a simple, easy, he's buying this deal for himself. He's 100% owner of it. And so we can see that the IRR of this deal is an 18.38. The average annual return is 23.9. The overall, cash on cash return average is an 11. So if you're somebody that, says, hey, my minimum cash on cash needs to be a 10% average annual return and I won't buy anything that's, below an 18% IRR, well, this deal would work for you, right? So we'll come over here and just kind of look at making sure that, the income is going to stay flat based on the way the lease is, right? Then we have all of the expenses being factored in here. The nice thing about a very simple, double net, triple net, single tenant is it's very easy to model deals, right? Because you don't have to really think about or factor in tenants coming in or out or tenant improvements or leasing commissions. It's pretty static in a deal like this. And again, that might hinder some of the upside that you can capture in some of those riskier deals. But the stability of this deal gives peace of mind to certain investors, and based on their goals and their strategy, this deal makes a ton of sense. So it's factoring in his debt service on the loan, right? And this is what's left over. $34,783. Now, with his $315,000 total dollars in on the deal, let me come back to the deal summary, right? You can see that the total member capital needed to close, and that's factoring in if there was CapEx, closing costs, his down payment. These are all things that it'll total in to here and tell you this is the total amount of money that you're gonna have to come to the table with to close this deal. It will factor in reserves, all of that, right? So his $315,000 is what we call the capital account balance. That is the total amount of money needed to close this deal. That is gonna be the capital account. And based on the returns that he generates each year, it is telling him that $34,000 of your $315,000 investment, that's an 11% return on that money. So that's great. If he's getting that year over year over year over year, right? That is something that he can factor in and say, does this meet my goals or does it not? So we come over here. If he wanted to do a refinance or something along those lines, he would factor that in here. He's not looking to do that. So he's just going to hold this for 8 years. And now we can punch in some of the numbers. He thinks he'll be able to sell it at an 8.5 cap at the end of year 8, based on the net operating income and an 8.5 cap, factoring in the sales costs. He can see that he's going to hopefully get his $315,000 back. He'll get another $324,000 on top of that. And his total cash back to him will be $639,000, which if you factor all those numbers in, his IRR on this deal is a little north of an 18% IRR and an 11% cash on cash return. So you can come over to the returns tab and see what he's making every year. And we can say, hey, he's going to collect over $278,000 in cash flow over those 8 years. And when he sells the property, he's going to make $325,000 on top of getting his $315,000 back. So overall, an average 23.9% on the deal, 18% IRR, 11%. And again, you can see that there's a lot of other intricacies with this sheet that, based on how you structure the deal, would show up and reflect in these different tabs. We'll go over that in a more advanced video, but I just, for the sake of this deal, wanted to show you guys, right, a very simple analysis of if somebody's looking for some boring, simple, stable real estate, you feel comfortable with the market, you feel comfortable with the tenant, you feel comfortable with these returns, this is a deal that I would give a thumbs up and move forward on. For this particular investor in the Wise Investor Collective, Greg, this over exceeded his goals and what he was looking to do. It's a market that's very close to home. He can drive to it. He can touch the asset. He feels good about the tenant. He knows what's going on in this area. And there's some actually big development that's happening with a new ammunition plant going in this market, some other good development that's happening around the area. So he feels good about where this is headed. The next investor may not feel as good about this deal, right? And this is where understanding how deal analysis, deal structuring, risk mitigation, all of these things can be critical for you to make a decision around where you want to offer, how you want to negotiate, how you want to structure the deal, and ultimately land on something that meets and aligns with your goals. Or if it doesn't, right, you can move on and allow the data to drive your decision making instead of the emotion. So hopefully this was helpful. Again, there's so many different ways of analyzing a deal. We're going to go over a ton of different ones on this channel. So if this was helpful, definitely smash that like button. If you're not subscribed, subscribe to the channel. And if you have any questions or comments, if I messed something up, if I need to clarify something, drop those down below as well. I will respond to all of those. And we got lots of great tools and resources for you at the wiseinvestorcollective.com, in our wiseinvestorvault.com, or a bunch of stuff down below. Until next video, we'll see you guys. Cheers.